Valuation Set C Paper 8. Which of the following statement about fair value is correct? Fair value is correct. Fair value is always equal to market value. No. Fair value consider exit price, not just historical cost. Fair value is determined solely based on intrinsic factors. No. Fair value ignores the most advantageous market. No. So the answer is B. Under the IBC 2016, who is authorized to conduct valuation? Any chartered accountant, a registered valuer, yes. A company secretary, no. A merchant banker, no. So the answer is B. Which valuation method is most appropriate for valuing a startup with high growth potential but negative cash flow? Assets based approach, discounted cash flow, yes. Market price method, no. Cost approach, no. So the answer is B. Which of the following is not? Which of the following is not a type of valuation? Fair market value, synergistic value, discount value, investment value. So the answer is C, discount value. When determining the fair market value of an asset, which condition is not necessary? Which condition is not necessary? The buyers and sellers must be unrelated. The assets must be sold in a forced sale situation. Both parties should act knowledgeably and without compulsion. There should be a competitive and open market. So, which is not necessary? So, the answer is B. The assets must be sold in forced sale situation. As per ICA valuation standards, which of the following is not recognized premise of valuation? Going concern value, no. Orderly liquidation value, no. Forced sales, yes. Guaranteed minimum value, no. So the answer is C. The uh, process of valuation includes only quantitative analysis of financial data, no. Only qualitative analysis of industry, no. A combination of both quantitative and qualitative, yes. Estimating the purchase price of any assets randomly, no. So the answer is C. What does intrinsic value primarily depends on? Intrinsic value, market demands and supply, no. Speculative factors in the market, no. The present value of future cash flow, yes. The highest bid received in an auction, no. So the answer is C. Which of the following best describe registered valuer? As per the company act, any financial expert with the valuation experience, no. A person registered under the companies rule 2017, yes. Any CA with minimum 5 years of experience, no. A merchant banker authorized under SEBI regulation, no. So the answer is B. What is the key difference between fair value and fair market value? Fair value and fair market value. A fair value considers market force, whereas fair market value is always fixed, no. A fair value considered a willing buyer and seller, whereas fair market value is regulated by law, no. Fair value is based on future potential, whereas fair market value is based on open market condition. Yes, fair market value is determined by the intrinsic analysis, whereas fair value is always estimated at cost. So the answer is C. Fair value is based on future potential, whereas fair market value is based on open market condition. In valuation, a synergistic value arises when two assets, when combined, generate a value higher than their individual sums. Yes, a business is acquired at its book value. No, the value of an asset determined based on its salvage price. No, an asset is valued at its liquidation price. No, so the answer is A. Which of the following act requires valuation by a registered valuer? Income Tax Act, FEMA, Companies Act, all of the above. So the answer is D, all of the above. What is the highest and best use principle in valuation? Highest and best use. The lowest price at which an asset can be sold. No. The use of an asset that maximize its value in the market. Yes. The book value recorded for accounting purpose. No. The current use of assets without any modification. No. So the answer is B. The liquidation value. The liquidation value of an asset refers to the highest possible selling price in an open market. Mm, no. The estimated realizable value if an asset is sold under forced condition. Yes. The purchase price of an asset recorded in books. No. The maximum insurance claim value of an asset. No. So the answer is B. Which valuation approach is most commonly used for valuing intellectual property like patents, IPR? Cost approach, income approach, market approach, forced sales approach. So the answer is B, income approach. Which of the following is not a purpose of valuation? Not a purpose of valuation. Investment decision, taxation and compliance, random price estimations, merger and acquisitions. No, so the answer is C, random price estimation, which is not a purpose of valuation. The Income Tax Act 1961 mandates valuation for determining fair market value of shares, assessing the liquidation value of assets, creating the business branding potential, estimating future tax exemption. So the answer is A, determine the fair market value of shares. Under the Company Act, who is required to conduct valuation? Who? A chartered accountant, a certified investment advisor. So the answer is C, registered valuer. Which of the following statement about transaction based value is true? Transaction transaction based valuation is true. It considered only transaction without industry analysis. It considered only past transaction without industry analysis. Now it involves comparing similar transactions in the market. Yes, it ignores the financial characteristic. No, it does not rely on any publicly available data. So the answer is B. The purpose of comparable transactions analysis in valuation is to determine the asset's replacement cost. No. Assess the market's historical pricing trends. No. Identify similar past transaction for valuation comparison. Yes. Set an arbitrary price. No. So the answer is C. Which factor is most critical in determining whether a past transaction is comparable in valuation? Past transaction is comparable in valuation. The CEO names. No. The total transaction value and industry similarity. Yes. The values personal background. No. The location of the acquiring company's office. No. So the answer is B. Which of the following acts govern valuation requirement for cross-border transaction? Income Tax Act, Companies Act, FEMA, SEBI Takeover Code. So the answer is C, FEMA. The SEBI Takeover Codes requires valuation for employee bonus calculation. No. Determining a fair exit price for minority shareholder. Yes. Setting the IPO price. No. Deciding the tenure of company director. No. So the answer is B. Why? Why does IVC requires valuation? To artificially inflate assets price? No. To determine the fair and liquidation value of assets? Yes. To avoid financial disclosure in corporate insolvencies? No. To predict stock market? No. So the answer is B. Which of the following is an example of regulatory based valuation? Regulatory based valuation. A company valuing its brand equity for marketing. No. A firm calculating its assets value for an internal strategy report. No. Valuation of an assets for SEBI compliance in an IPO. Yes. A business estimating future profits for employee bonuses. No. So the answer is C. The FEMA requires valuation in cases involving domestic private placements, no foreign investor purchasing Indian company shares. FEMA. Internal corporate audits, no. Business mergers within the same country, no. So the answer is B. In capital raising, valuation is most important for in capital raising. Valuation is most important for estimating the book value of old shares, determining the fair pricing for new shares and debt instrument, assessing the cultural value of company, evaluating annual employee performance. So in capital raising, valuation is most important for determining the fair price of new shares and debt instruments. So the answer is B. In performance evaluation, valuation helps in measuring actual market value against intrinsic value, yes. Guessing an estimated price without calculation, no. Ignoring financial performance trend, no. Calculating total corporate taxes and liability, no. So the answer is B. Stakeholder communication requires valuation too. Conceal the company's actual worth. Stakeholders communication requires conceal the company's actual growth, no. Provide a transparency in financial reporting and decision making, keep investors unaware of financial changes, no. Avoid corporate governance, no. So the answer is B. In strategic planning, valuation is critical for evaluating a potential acquisition target, determining a company's holiday budget, estimating employee satisfaction levels, predicting social media engagement rates. In strategic planning, valuation is critical for evaluating potential acquisition targets. So the answer is A. Which of the following is not? Which of the following is not commonly used valuation approach? Market based approach, income or earnings based approach, assets or cost based approach, no. Liquidation based approach. So which is not commonly used valuation? So the answer is D, liquidity based. The discounted cash flow method is a part of which valuation approach? Discounted cash flow. Market based approach, no. Assets based approach, no. Income based approach, yes. So the answer is C. Which method is commonly used? Valuing loss making a startup with potential future cash flow. It's a discounted cash flow method, so the answer is C. In the market based approach, which following is not a key factor? Market based approach. For selecting comparable companies, a similar industry and market condition, no. Similar revenue and profit margins, no. The CEO leadership styles, yes. Recent transaction in the same sector. So which is not a key factor? So the answer is C. Which of the following is not considered an observable input in valuations? Market price of similar assets in an active market, quoted interest rate from government bonds, management expected sales growth for next 10 years, recent transaction price for identical assets, which is not considered. So the answer is C. The control premium adjustment in valuation is applied when the business is being valued under a forced sales scenarios. The acquirer gains significant influence over the company's operation. The business has high liquidity reserve. The valuation is based on historical cost accounting. So the control premium is applied when acquirer gains significant influence over the company's operation. So the answer is B. Under the CCM method, which multiple is generally not used? Price earning ratio, enterprise value to sales, earning per shares multiples, WACC multiple. So the answer is C, EPS multiple. What is the main challenge in applying the market based approach to a startup valuation? What is main challenge in applying the market approach to a startup valuation? A startup often lacks historical profit data and market comparable years. The approach requires knowledge of advanced financial derivatives, no. Market prices are always stable. No, it is illegal to use market data. No, so the answer is A. Startups often lack historical profit data and market comparable. The WACC is generally used as a discount rate in which of the following method? So WACC is used in free cash flow to of firm method. So the answer is B. Which of the following valuation approach is least suitable for a company with significant intangible asset and brand equity? A discounted cash flow approach, market-based approach, cost-based approach, synergistic value approach. So the answer is C, cost-based. In the CCM method, what is the primary basis of valuation? In the CTM method, what is the primary basis? Fast acquisition price of similar business, yes. The company's internal financial forecast, no. The book value of an of assets on balance sheet, no. The tax adjustment historical profit, no. So the answer is what is most appropriate valuation method for an infrastructure project with predictable long-term cash flow? So the answer is C, discounted cash flow method. In the fair market value concept, assume that the buyers and sellers, fair market value, buyer and sellers, are related party with inside information, are acting under compulsion due to financial distress, having reasonable knowledge of the assets, are willing participant, and are willing participant ignore external market conditions. So assumption, what are the assumptions? That the buyers and sellers have reasonable knowledge of the assets and are willing participants. So the answer is C. Which of the following statement about terminal value in DCF valuation is incorrect? Terminal value represents the value of cash flow beyond the forecast period. A high terminal growth rate always result in lower valuation. The Gordon growth model is commonly method for estimating terminal value. The terminal value can often be a largest component of DCF valuation. So the which is incorrect. So the answer is B. A high terminal growth rate always result in lower valuation.